what you need to know about gold and silver's connection to the yen problem. At first glance, this may sound like another story about foreign currencies, but what if the real issue has nothing to do with Japan alone? What if a weakening yen is quietly exposing a much larger weakness inside the global financial system? One that could reshape bond markets, pressure the US dollar, and change how serious investors look at gold and silver for years to come. Behind one currency sits trillions of dollars in government debt, hidden market interventions, and a financial chain reaction that very few people are paying attention to. The question is no longer whether the yen has a problem. The real question is, who else gets pulled into it when that problem can no longer be contained? Stay with us, because by the end of this video, the connection may look very different than you ever imagined. Welcome to Next Alert. If this is your first time here, you're among people who believe that understanding the economy today is one of the best ways to prepare for tomorrow. If you haven't subscribed yet, please consider joining our community. It costs nothing, but it may help you stay informed as the financial world continues to change in ways that deserve careful attention. And before we begin, we'd love to know where you're watching from today. Let us know your country and city in the comments. We enjoy seeing our community grow from all around the world. Only a handful of events have the power to shake global financial markets before most people even realize something important has happened. A sudden military conflict can do it. A surprise interest rate decision can do it. And sometimes it begins with something that appears far less dramatic, a single currency moving far beyond what policymakers are willing to tolerate. That is exactly why the recent movement in the Japanese yen deserves far more attention than it has received. For many investors, currency markets seem distant and overly technical. Stock prices attract headlines. Gold prices spark debate. Oil dominates geopolitical discussions. Yet behind all of these markets sits an invisible network of currencies that quietly determines how money moves around the world. When one of the world's most important currencies begins behaving abnormally, experienced investors immediately start asking a different question. What does the market know that everyone else is missing? The Japanese yen is not simply Japan's national currency. For decades, it has served as one of the pillars of the international financial system. It influences global lending, international trade, government borrowing, and investment flows that stretch from Tokyo to New York, London, Frankfurt, and Singapore. This is why large movements in the yen rarely remain isolated events. They often become the first signal that deeper financial pressures are beginning to surface. Recent market activity has once again pushed the yen into that uncomfortable spotlight. Policymakers have faced increasing pressure as the currency weakened, forcing difficult decisions about whether to intervene, adjust interest rates, or allow markets to continue moving on their own. Each option carries consequences that extend well beyond Japan's borders. A stronger intervention may temporarily stabilize confidence, but it also raises questions about how sustainable that support can be. Allowing the currency to weaken further could create even greater uncertainty, encouraging investors to reconsider where they store wealth and how they manage risk. Neither outcome is simple. The reason is straightforward. Japan is not an ordinary economy. It remains one of the largest creditors in the world and plays a central role in global government bond markets. Its financial institutions manage enormous pools of capital, while its policies influence borrowing costs that affect businesses, banks, and governments across multiple continents. Because of this unique position, movements in the yen often trigger reactions that ripple through markets many people never associate with Japan at all. This brings us to gold and silver. At first glance, precious metals appear unrelated to currency movements. Gold is viewed as a store of value. Silver serves both industrial and monetary purposes. The yen, meanwhile, is simply another national currency. But global finance rarely operates in isolated compartments. Currencies influence bond markets. Bond markets influence interest rates. Interest rates shape investor confidence. And confidence ultimately determines where capital flows when uncertainty begins to rise. That is the connection serious investors are watching today. The discussion is no longer limited to whether the yen becomes stronger or weaker over the coming months. The larger concern is whether stress inside one of the world's most important financial systems could begin spreading into other markets that millions of businesses and investors depend upon every single day. History has repeatedly shown that financial instability rarely announces itself with a dramatic warning. Instead, it begins quietly. A currency weakens. Bond yields start climbing. Liquidity becomes more difficult to find. Confidence slowly begins to erode. Only after these pieces connect does the broader market recognize that the story was never about a single currency. It was about the stability of the financial system itself. And if that process has already begun, then understanding what happens next may prove far more important than watching the daily price of gold or silver alone. Imagine standing in a room filled with thousands of perfectly aligned dominoes. The first one does not need to be the largest. It only needs to fall in the right direction. That is how modern financial markets operate. Contrary to popular belief, global crises rarely begin with stock market crashes. They usually begin much earlier, hidden inside markets that receive very little public attention. Currency markets, government bond markets, and interbank lending often reveal the first signs that something beneath the surface is beginning to fracture. The Japanese yen sits at the center of one of those hidden systems. For decades, Japan has quietly become one of the world's largest financial creditors. While headlines often focus on America's debt, China's economy, or Europe's inflation challenges, Japan has accumulated an enormous stockpile of overseas assets, particularly U.S. Treasury securities. This relationship created a financial partnership that benefited both countries. The United States gained a dependable buyer for its government debt. Japan gained a stable destination for its massive financial reserves. For years, that arrangement helped maintain confidence throughout the global financial system. But every stable system has a pressure point. And today, that pressure point is beginning to emerge. As the Japanese yen weakens, defending the currency becomes increasingly expensive. Policymakers cannot simply hope that confidence returns on its own. Eventually, they are forced to make difficult decisions, and none of those decisions come without consequences. One option is to raise interest rates, making Japanese assets more attractive to investors. Another is to intervene directly in currency markets by supporting the yen with foreign reserves. A third possibility involves selling portions of Japan's vast holdings of U.S. government bonds to generate the dollars needed to stabilize its own currency. That final option is where the situation becomes far more significant than most investors realize. Government bonds are not just investment products. They are the foundation upon which modern financial markets are built. Their prices influence mortgage rates, corporate borrowing costs, business expansion, banking stability, and even the valuation of stock markets across the world. When one of the largest holders of those bonds begins reducing its position, supply increases. And when supply increases faster than demand, prices begin to fall. Lower bond prices create higher yields. Higher yields increase borrowing costs. Higher borrowing costs place pressure on governments, corporations, households, and financial institutions simultaneously. This is why experienced investors pay close attention whenever Japan's financial position changes. The issue extends far beyond currency fluctuations. It becomes a question of liquidity. Can global markets continue absorbing enormous quantities of government debt without disrupting financial stability? That question becomes even more important when governments around the world continue issuing new debt at historic levels. If confidence weakens at the same time, additional supply enters the market, the effects can spread much faster than many expect. Financial history repeatedly demonstrates that markets rarely collapse because of a single event. Instead, crises emerge when multiple vulnerabilities begin reinforcing one another. A weakening currency, rising bond yields, growing debt burdens, declining investor confidence. Each development appears manageable in isolation. Together, they create conditions capable of reshaping global capital flows. This is precisely why professional investors are watching Japan so closely. Not because Japan alone determines the future of the global economy, but because it may become the first domino that reveals just how interconnected today's financial system has become. And if that domino continues to fall, the next market to feel the pressure may not be currencies at all. It could be the very assets that millions of investors have long considered the safest place to preserve their wealth. Every financial system is built on one invisible foundation: trust. The trust that governments will honor their debts, the trust that currencies will preserve purchasing power, the trust that central banks can maintain stability whenever markets begin to lose confidence. As long as that trust remains intact, money continues flowing through the financial system almost effortlessly. But history teaches an uncomfortable lesson. When confidence begins to weaken, investors stop asking one question and immediately start asking another. Not, where can I earn the highest return? But instead, where can I lose the least? That shift in thinking changes everything. Capital that once chased aggressive growth suddenly begins searching for protection. Risk becomes less attractive than certainty. Liquidity becomes more valuable than speculation. And assets that spent years sitting quietly in the background suddenly move to the center of every serious investment discussion. This is precisely where gold enters the story. Gold does not generate quarterly earnings. It pays no dividend. It promises no rapid growth. Yet for thousands of years, during periods of financial uncertainty, governments, institutions, and private investors have repeatedly returned to it for one simple reason: it carries no counterparty risk. Unlike a government bond, gold does not depend on a nation's ability to repay debt. Unlike a currency, it cannot be diluted through monetary expansion. Unlike corporate assets, it does not rely on business profits or consumer demand. Its value depends primarily on one thing: the confidence people place in the financial system surrounding it. The more uncertainty spreads through that system, the more attractive gold often becomes. Silver follows a similar path, but for different reasons. Unlike gold, silver occupies two worlds at once: It is both a monetary asset and an industrial commodity. It protects purchasing power during periods of financial stress while simultaneously supporting industries ranging from electronics to renewable energy and advanced manufacturing. That unique combination often causes silver to behave differently from gold. During the early stages of uncertainty, investors frequently move toward gold first. But once confidence continues deteriorating and capital begins flowing more aggressively into precious metals, silver has historically demonstrated periods of much greater price volatility, both upward and downward. This explains why experienced investors rarely evaluate precious metals in isolation. Instead, they examine the broader financial environment. They watch sovereign debt levels. They monitor central bank decisions. They study real interest rates. They follow currency markets. And increasingly, they observe central bank gold purchases around the world. That final trend deserves particular attention. In recent years, central banks have steadily increased their gold reserves at one of the fastest paces seen in decades. This is not a speculative decision. It represents a strategic shift by institutions responsible for protecting national financial stability. Their actions suggest growing interest in holding assets that remain independent of another country's monetary policy. When institutions responsible for managing trillions of dollars begin adjusting their reserves, experienced market participants take notice. Not because they expect immediate market reactions, but because such decisions often reflect long-term concerns rather than short-term opportunities. This brings the discussion back to Japan. If pressure on the yen continues, if bond markets become increasingly unstable, if governments are forced into more aggressive interventions, then investor behavior may begin changing in ways that extend far beyond currency markets. The real story may never be about whether gold or silver experience temporary price swings. The deeper question is whether confidence itself is beginning to migrate away from traditional financial assets towards stores of value that exist outside the modern monetary system. Because if trust becomes the world's scarcest financial asset, then the demand for assets that require no promise, no repayment, and no government guarantee could become one of the defining investment themes of the years ahead. Every financial cycle eventually arrives at a moment when investors must make a decision. Not because they know exactly what will happen, but because uncertainty itself becomes too significant to ignore. That moment may be approaching once again. The Japanese yen has become far more than a regional currency story. It has evolved into a global indicator, one that reflects mounting pressure inside a financial system built on decades of expanding debt, exceptionally low interest rates, and the assumption that central banks can always restore confidence whenever markets begin to weaken. History suggests that assumption deserves careful examination. No central bank can permanently control market psychology. No government can borrow without limit. And no financial system remains immune when confidence begins shifting faster than policymakers can respond. The question, therefore, is not whether Japan alone can stabilize the yen. The larger question is whether policymakers around the world can preserve confidence in a system that is becoming increasingly dependent on intervention. That is why the months ahead deserve close attention. Professional investors will not focus solely on gold prices or daily movements in silver. Instead, they will monitor the signals that often appear long before major market trends become obvious. The first signal will be the Japanese yen itself. If the currency continues experiencing unusual volatility, it may indicate that underlying pressures remain unresolved despite official intervention. The second indicator will be U.S. Treasury yields. Higher yields may appear attractive at first glance, but sustained increases often signal that borrowing costs are becoming more difficult for governments, businesses, and consumers alike. The third indicator will be decisions from the Bank of Japan and the Federal Reserve. Every policy announcement will be analyzed not only for what is said, but for what those decisions reveal about the challenges policymakers are attempting to manage behind closed doors. Finally, attention will remain fixed on central bank gold purchases. When institutions responsible for managing national reserves continue accumulating gold over extended periods, markets naturally begin asking why. These are not emotional decisions, they are strategic ones. For entrepreneurs and business owners, the lesson extends beyond investment portfolios. Periods of financial transition influence borrowing costs, consumer demand, expansion plans, hiring decisions, and access to capital. Understanding these macroeconomic shifts is no longer reserved for economists or fund managers. It has become an essential part of long-term business strategy. For investors, however, the greatest mistake may be assuming that certainty is required before taking sensible precautions. Financial history rarely rewards those who wait until every headline confirms a developing trend. By that point, markets have often moved much further than expected. At the same time, history also warns against making reckless, all-or-nothing decisions based on fear. The strongest portfolios are rarely built by predicting a single outcome. They are built by preparing for multiple possibilities. That is the distinction between speculation and strategic risk management. Whether Japan ultimately raises interest rates, whether interventions continue, whether bond markets remain stable, or whether confidence gradually shifts toward hard assets. Each path points to the same underlying reality. The global financial system is entering a period where structural forces matter more than short-term headlines. Debt levels remain historically high. Currency markets are becoming increasingly sensitive. Central banks face narrowing policy options, and investors are paying closer attention to stores of value than they have in many years. Perhaps the most important lesson is this. The story was never simply about Japan. It was never only about the yen, and it was never just about whether gold or silver might rise next. The real story is about confidence, because every financial system ultimately rests upon it. When confidence strengthens, economies expand, investment flourishes, and markets reward optimism. But when confidence begins to erode, capital quietly starts searching for safety long before the broader public recognizes what is changing. Whether that shift has already begun remains one of the defining questions facing the global economy today. And the answer may shape financial markets for years to come. Thank you for watching Next Alert. If you found this analysis valuable, subscribe to the channel and join us as we continue breaking down the economic forces shaping tomorrow's financial world. And before you go, tell us in the comments, do you believe the yen is simply facing a temporary challenge, or is it signaling a much larger shift in the global financial system?